This is Matt McCormick with Columbia Chamber of Commerce, and welcome to our weekly webinar. This program is being recorded and will be available on the Chamber's social media pages and on the Chamber's COVID-19 resource website located at columbiamochamber.com following the event. If you've not done so, please mute your microphone so that our guest speakers can be heard easily by everyone on the call. We would also like to know who is joining us on the call today, so please type in your name and your business or the organization that you represent into the meeting chat function there to the side. Lastly, if time allows, at the end of the webinar, we'll take questions via the meeting chat feature as well. So if you have a question throughout the presentation, please make sure you type that in there, and we will ask those questions as time allows. Today, we'll be discussing payroll tax credits, Social Security, deferments, as well as some of the latest updates on the Paycheck Protection Program that started last Friday, as the rules continue to change and as new information comes from the feds. So joining us on the call today to speak with us about these topics are Jeremy Morris and Mark Gingrich. Both are tax partners and members with Williams Keepers LLC. I'd like to thank both of you for taking time out of your busy schedule to be on this webinar this morning. Jeremy and Mark, are y'all there?
I'm here. I'm here and unmuted, good Lord willing.
Well, wonderful. Thank y'all so much for taking your time. Again, for everyone attending, please be sure that your microphones are muted throughout the duration of the webinar. If you have a question, please put it in the chat feature and we'll get to those at the end as we go. So Jeremy and Mark, I'd like to turn this over to you to discuss payroll tax credits, Social Security deferments, and any new regulations that and help that you can give everyone on the PPP program. So I'll turn this over to y'all and let you get rolling.
All right. Well, thank you very much. Yeah, we appreciate the opportunity to be here. We're gonna discuss. We had originally talked about discussing, the payroll tax credits, the deferment, and we will touch on those. But we kind of wanted to roll back into the PPP aspect of that as well. I mean, part of it is we know that tends to still be on the front of mind. And as it relates to some of these other opportunities that we're looking at, we don't get the option to do a both and. In other words, we can do either the PPP or some of these other options. So, and we'll make sure we note that. So we're going to start off with a couple of items that came into the Families First Act, which can be used in conjunction with the PPP. We'll then hit on a couple of other tools or strategies as it relates to payroll taxes, either deferrals or credits. But, we won't end up spending quite as much time on those because those can be used they can't be used with the PPP. So you choose one or the other. If you are going to access the PPP program, then you don't have the ability really to use these particular tools. So we'll cover them at a high level, but we'll make note of the fact that it is an either or as it comes to those. We do plan on having a bit of time for questions. Again, we would welcome those. And if anyone has any other, questions that maybe we don't get to today, we did a similar, a little bit more broad webinar earlier this week that you can access on our website for free along with audio. And we did about an hour-long presentation and about an hour-long Q&A associated with it. So if there's some questions that maybe we don't get to or something comes up after the fact, those resources are there. But before we begin, anything I think I would kind of say maybe with respect to all of this is make sure throughout this process, whatever strategy it is that you're trying to pursue, make sure you're talking to your advisors, whoever they may be. Again, whether that's your CPA, definitely your CPA, definitely your banker. They're going to have different roles to play as it relates to these. If you work with someone specifically for your payroll, same thing. They're going to have specific roles to play, and just make sure you're working with them throughout the process, because everybody's situation, is going to be different as it relates to the specific situation and what tools or strategies work best for you. So having said that, let's jump into these payroll tax credits, specifically as it relates to the Families First Act. So this was the first, this was prior to the CARES Act. Again, it feels like it's been about 3 months ago since this was passed. And, obviously it hasn't been that long, but a lot has happened since then. So the Families First Act, within a larger relief bill, was trying to provide relief for employers to provide leave associated with employees that had to take leave due to COVID-19 related reasons. So one particular issue related to that, or one thing that was created, was this idea of emergency sick leave. So what it required was that employers with fewer than 500 employees, it required them to pay up to 80 hours of sick leave to employees who met one of these really 5 situations related to COVID-19. They list 6 in the Act, one of which, the last one, is kind of gives them the ability to sort of, if there's a situation that doesn't neatly fall within the first 5, but is close to, Treasury and Department of Labor can approve that. So really, for all intents and purposes right now, it's 5 reasons. If an employee has to take leave for one of those reasons, the employer is required to provide up to 80 hours of sick leave. Again, if they're full-time, they get the 80 hours. If they're part-time, it's based upon, the number of hours is based upon their normal amount of hours that they work. So the employers are required to provide this, but they are then given access to a tax credit via the form of being able to hold on to amounts they would otherwise pay over to the government as payroll tax withholdings. Okay. And that amount of the credit ties to the amount that they are required to provide under the Act. So what you end up getting then is a situation where any amounts that are required to be paid under this Act for emergency sick leave in these situations, they are reimbursed, the employer is reimbursed for those via payroll tax withholding. So let me give you an example. So basically, if again, I mentioned 5 reasons, the first 3 of these reasons really relate to an issue with the employee. So for example, the employee is quarantined or experiencing COVID-19 symptoms, or they're seeking a medical diagnosis to determine whether or not they have COVID-19. If the employee is taking leave related to one of those situations, the employer is required to provide, again, for full-time employees, up to 80 hours of leave at 100% of that employee's normal pay, but it caps out at $511 a day. If the problem is with the employee's family, and that's what's causing leave, for example, the employee is caring for someone that's subject to quarantine, or to care for a son or daughter whose school or daycare is closed due to COVID-19. That's going to probably be the issue we see most often. If it's related to one of those reasons, the employer is required to provide leave and required to pay 2/3 of that employee's normal pay, and that maxes out at $200 per day. Okay. As I mentioned, though, the employer gets reimbursed for this. So the employer, in that first 3 situations where the issue is with the employee and the employer is required to pay 100% of their normal pay, the employer is eligible for a tax credit equal to 100% of the employee's normal pay that they're paying under this, up to $511 per day. So there's a consistency there. Same thing if it's with the other, if it's the other issues, the amount of the credit is 2/3 of the employee's normal pay, up to the $200 per day. Now, an employer, in the case of those second situations, where they're only required to pay 2/3 of the employee's pay, the employer could provide up to 100% of the employee's pay. There's nothing stopping them from doing that, but you don't get extra credit, so to speak, as it relates to the payroll tax credits that you get. If you decide you want to provide an employee leave and pay them 100% of what they were making while they're on leave to watch their child, whose school is closed, you can pay them that, but your reimbursement will be limited to 2/3 of their pay, or the maximum of $200 per day, regardless if you pay beyond that. So again, the idea is to provide employees with paid leave if they're off related to COVID-19 related reasons, but to give the employer a tax credit associated with it. And again, the way they get that tax credit is whenever it comes time to make payroll tax deposits, they get to withhold the amount of the credit that's due to them. They just hold on to those funds. If the amount of the credit due to them is in excess of the amount of their payroll tax deposit, then there is a refundable credit that will be a refund that will be due to them associated with that. So that's the emergency sick leave portion. At this point, I'll turn it over to Mark to discuss kind of the companion piece of this, which was the what we are kind of are terming emergency FMLA or FMLA plus.
Thanks, Jeremy. And again, I think to emphasize, the credit that Jeremy talked about is a payroll tax credit. The credit that I'm about to talk about is a payroll tax credit. And so that makes it available to employers that do not pay income tax. Okay, so Jeremy talked about the 5 situations where an employer is required to give up to 80 hours paid leave to individuals. I'm going to talk about a very narrow application, or a very narrow additional leave requirement and credit that is its companion. But as Jeremy well referenced, with many of the schools, all of them locally, unable to convene, we have a lot of people that fit within this narrow rule. So what we call FMLA plus, or paid FMLA, applies only in one situation. It applies to small employers, employers under 500 employees, measured using the FMLA rules for counting number of employees for an employer. And it provides up to 12 weeks of FMLA benefit, 10 of which are paid. So the two regimes are distinct, the one Jeremy described and the one that I am describing now, but they can be used in concert if an FMLA event is triggered at the outset. That can trigger 80 hours, which roughly equates for most employees to 2 weeks, 10 days of paid leave. And then the first 2 weeks under the FMLA plus regime, which covers 2/3 of an employee's normal salary up to $200, but again, only for the reason of somebody who's caring for a son or daughter whose school or daycare is closed due to COVID-19. So that's the only situation we get into FMLA plus the 10-week benefit. So if we're in the 10-week benefit, we can trigger the emergency sick leave for the first 2 weeks. We can trigger FMLA plus for the next 10 weeks. And it requires the employer then to pay 2/3 of the employee's normal salary, capped at $200 a day. And if the employer does the minimum that's required, then there are tax credits available to offset the amount of leave paid under the provision. Like the provision that Jeremy described, there's no extra credit for being an overachiever. If you pay somebody 100% of their normal salary for the 10 weeks, then you have done something good for that person, but there is no direct credit subsidy for that expenditure, the excess of the 1/3 of their salary that exceeds the 2/3 allowed and funded by the credit. Again, this is a payroll tax credit, and we've seen a lot of questions about some of the exemptions to this credit. One of which is an exemption for employers with 50 or fewer employees. And that exception requires a demonstration that satisfying this requirement would jeopardize the going concern status of the business. And our view is that that's a very difficult showing to make, where the minimum that's asked of a business is exactly equal to the tax credits provided. And as Congress, I think, conceptualized these provisions, they expected the credits to come back at the end of a quarter, which could create a timing issue for businesses. But the IRS has come out with favorable guidance that said, employers, just keep the money you were otherwise going to give us on your employees who are able to work, and we'll cut you a check. We'll cut you a check later if we still owe you money. So for a lot of businesses, it's going to be difficult to succeed in showing that that they are an exempted under 50 employee business, because it will be hard to show that the federal payment of the amounts required is inadequate to keep the business in business. Okay, so we are talking in a vacuum of sound, and so I'm going to kick it over to Jeremy to talk about payroll tax deferral, and then we will look forward to kicking it open to questions here shortly.
Yeah, thank you, Mark. And so maybe to kind of put a bow on what we just talked about and maybe help segue into these next two items. Again, a lot of the questions that we're seeing, you guys had we had a webinar last week. The chamber webinar was related to the payment of the Paycheck Protection Program, or the PPP. It's worth noting that the items that we just discussed can be used in conjunction with that program. In other words, there is nothing, stopping you from receiving the tax credits associated with providing that leave and still accessing the PPP loans. The only thing that you cannot do in that situation is double dip. And what I mean by that is you can't duplicate the tax benefits. So any amounts that an employer pays under those two leave policies, to the extent they receive reimbursement for amounts paid for leave, as Mark and I just described, they cannot use those wages as wages that would provide loan forgiveness under the PPP. Because again, the PPP, if you recall, loan forgiveness is based upon how much of that you use towards payment of necessary expenses during the 8 weeks after you receive the loan, and in very specific sets of expenses. So payroll, rent, interest, utilities, and most of that is going to be payroll. Okay. You cannot use as payroll cost for loan forgiveness amounts paid under these leave programs that you receive the credit for. And so that's what we mean by not being able to double dip. Okay. This next item is something that will provide businesses not necessarily a credit, but it will provide them an opportunity to maybe solidify or firm up or help their current cash flow situation. Okay. Because it results in a deferral of payment of payroll taxes. There is a catch with this, though, associated with the PPP, but let's discuss, I guess, specifically the tool or the strategy. So in order to help businesses hold on to cash during these tougher times and hopefully help them weather the storm, employers have the ability to defer payment of employment taxes that are due beginning with the date of enactment, and this is related to the CARES Act, through December 31st of 2020. 50% of those deferred payroll taxes will be due on December 31st of 2021, with the remaining 50% due on December 31st, 2022. So you get, in some instances, over a 2-year deferral associated with payment of this. Okay? Which again, the whole idea is to help businesses be able to hold on to their cash now, as cash tends to be a little bit more tight for businesses in these tough times. The catch with this, though, as it relates to the PPP, is that this is all well and good, but if you access the PPP loans and you receive forgiveness of indebtedness under PPP, which is what everyone is trying to get under this program, this deferral is not available to you. So if for some reason you can't access this program, or for some reason choose not to access the PPP, then know that this deferral is available. If you are accessing that program and looking for loan forgiveness, then the deferral option of payroll taxes is not available to you. So with that, I'll turn it back over to Mark to discuss one final payroll tax credit that kind of falls within this same bucket as an either-or situation as it relates to it and the PPP.
Let's try again. I'm unmuted now. Thanks, Jeremy. All that good learning to find out that 90% of those on this call aren't going to be eligible for it. But I think an example of an interested organization that might be is if you're a nonprofit organization that doesn't fit within 501c3 or C19. And so I think those are the only two that have access to the PPP. So if you're a C6 or something else, that these benefits that we're talking about under the payroll deferral and then this employee retention credit that I'm about to describe get a lot more attractive. Okay, so I spoiled what I'm going to talk about, but here it is, the Employee Retention Tax Credit. So the Employee Retention Tax Credit, again, is available only to employers who didn't access the PPP. So if the government is indirectly funding your payroll for a couple of months through the PPP, then you have 2 months of payroll covered at 100% of the cost. If you do not have access or can't get access to that program, then the employee retention credit kicks in. It kicks in only for certain businesses, and it's a wide swath of businesses now in our current environment, but it kicks in one of two situations. Either the business has had a significant downturn in revenue, and by significant, they defined it as for the quarterly results, so presumably Q2 2020. The full quarter results, revenue is more than 50% reduced from the same quarter previously. Okay, so that would be one way to get into the employee retention credit. The other is that you have been forced to close by a governmental organization. So the forced closure pathway into this program works for for-profit or not-for-profit businesses, but the gross receipts test is available only for for-profit business entities. So if you trigger either of those, a full or partial suspension during a calendar quarter from a governmental authority that's limiting commerce, travel, group meetings, etc., as a result of COVID, if you're shut down for those reasons and you don't get the PPP money, this credit's for you. Alternatively, if you aren't ordered shut down, you're an essential business, but the impact of COVID shrinks your gross receipts for the quarter by more than half of what it was before, then this credit is for you. And depending on whether businesses are over 100 employees or under 100 employees, there's different math on exactly which wages are going to qualify. But I think the important thing to keep in front of us here is that this is a 50% credit, and it's capped on a per employee basis at $5,000 per employee per quarter in credit, which equates to $10,000 per employee per quarter in wages. And so it is, if a business has the choice between the PPP and this program, the PPP is almost always superior. In the situation I described, for a business that has a reduction of its gross receipts by more than 50%, the credit stays in effect for every quarter through the end of the year, as long as the business's gross receipts have stayed below 80% compression relative to prior quarter results. So you have a significant downturn from COVID, more than 50% cut in gross receipts, and you haven't sprung back up to the 80% mark. For every quarter that's true, this credit kicks in. And so there's the potential that someone who continues to pay their employees quarter after quarter could continue to get contributions from this employee retention credit for multiple quarters. But all of us, I know, have our fingers crossed that this COVID business is shorter lived, not longer lived, and that we will, even if it's not a return to normal, return to something closer to 100% of prior year results sooner rather than later. So under that way of thinking, the PPP, and many of the participants on this call will have already applied. The PPP is the way to go, and this employee retention credit is available for those who cannot access or for some other reason do not access the PPP program. All right, a lot there on the employee retention, and we spared you some of the agonizing details, but wanted to make sure that we don't lose visibility on how this fits into the overall scheme of things. All right, I think that concludes the materials that Jeremy and I wanted to cover independent of the PPP. Jeremy, let's maybe have a quick discussion on what we know and what we don't know about the PPP, and then we can kick it open for questions. I know that we've encouraged people to chat those in, and if I'm seeing the full list, I don't see any questions yet. So somebody message me if I'm looking at that wrong. But let's think about how this fit, where we are on PPP, and you know, that's become a buzzword that we all just kind of rattle off the tip of our tongue now, and it didn't exist 2 weeks ago. So our banking partners have done a great job of standing this up. I've joked internally that well, to frame it, the PPP program was rolled out in phases. Phase 1 was for businesses that have employees. Phase 2 is for self-employed individuals. There's some businesses that fit both. For example, tax partnerships, where the partners are treated as self-employed people, not as employees of the business. Contrast that with S corporations, where the owners in many cases are required to be treated as employees of the business, even though they might prefer to have a draw instead of a wage. And so we had the rollout first of the employees phase. This week, starting tomorrow, we're supposed to have the rollout of the self-employed phase. We got the guidance last week, interim rules. I think it was around 4 or 5 o'clock Eastern on Thursday for the program that was going live on Friday. I know that made a fun night for some of our banking friends Thursday night. Last I checked, we don't have the rules. We don't have the rules yet for the self-employed individuals yet. I put out internally in our firm an under over for 5 p.m. Eastern for those to roll out. We'll see where the office pool goes on that. But that's something that I know we're all waiting for with anticipation as we see the available funds in the program trickle down, reduce. We see calls in Washington to replenish. We see people who are trying to apply but don't know what paperwork to fill out, and banks not sure what to tell them yet. So Jeremy, what have I missed on where we are on the PPP?
No, I think that's it. I mean, I think a lot of the people that were, a lot of our, business clients, the banks helped them through last week, and the applications are in. Again, I think everyone is waiting to figure out how those self-employed individuals will be impacted. And then it's going to be a matter of where our focus moves next is, okay, the funds are here. What is it that we need to document the appropriate use of the expenses? And more importantly, how do these other rules that relate to, making sure you're maintaining the proper number of employees, how to make sure you're maintaining the appropriate wage levels, because if there's a reduction in those, it does limit your ability to get the forgiveness. So, that's, I think, where we're moving next. But yeah, at this point, what we're waiting on in the immediate term is guidance for tomorrow on specifics related to how self-employed individuals can apply. I did one question here. Let's get to that. The question is, will you restate why 90% of us won't be able to get the PPP? I think I apologize, a little bit of a misunderstanding there in how we described that. there no limit, no concerns about people's ability to access the PPP. Absolutely no concern about that. The comment that we made was, is it related to some of these payroll tax provisions and tax credits or deferrals that we were talking about, specifically the last two, the payroll tax deferral and the employee retention credit. Again, we spent some time talking about them, but for 90% or for most of the people probably on this call, we didn't think they would have a lot of actual applicability because those people have already accessed the PPP. So put in other ways, we aren't saying you're limited in taking the PPP, but if you have accessed the PPP loans, then those two strategies that we discussed, those are what are not available to you.
Jeremy, thanks for clarifying that. I think I said it in a confusing way on my part. Thinking about strategy, if we think about the PPP loan program, we've had a lot of discussion internally and with our banking partners to try to understand the closing time frame. And we know that there's an immense political pressure on the administration and others to get these loans funded. But for a lot of businesses who are shut down, for dentists who really can't put their hands in people's mouths for the next little bit, for those people, rushing to the till and closing on the PPP loan gets them cash, but it makes it harder for them to qualify for full forgiveness because they need to be paying employees to be providing services. Otherwise, they're just writing employees a check to keep them employed, which, in fairness, was the purpose of the PPP program, but may not be the optimal strategy for the business owner. And so one idea that we've worked on and talked about is the two credits we led with can be used in conjunction with the PPP program. So if a business has folks who are out caring for kids because they're out of school and that prevents them from working or teleworking, which is a requirement to fit within that program. So the teleworking part, I think, is important. If you have a large group of your employees that you're doing the right thing, you're paying them, you're keeping them on the payrolls, and they have not been pushed off to unemployment. For the tax, as Jeremy well described, you can't double count those wages which are subsidized by the tax credit. You can't count those for loan forgiveness. And so a strategy is, if you have a lot of your employees who are on that program already, who are out of work, can't telework because of being at home and doing homeschool with the kids, for those people, if you continue to pay them, the best strategy would be to wait to close your loan. And so we've been talking with our banking friends and trying to get our arms around what are the constraints on that strategy. And guidance came out yesterday, and I believe it's SBA wide now. I think initial guidance was maybe just out of the St. Louis office, and now it's expanded to nationwide. Jeremy, I'll let you jump in a second if I'm wrong on that. But that they want the SBA loans closed within 10 business days of approval. So that gives you 2 weeks to do this strategy. So maybe we can get to a situation if a large chunk of our workforce is out on leave and we're continuing to pay them, we can take advantage of the federal tax credits for week 1, the federal tax credits for week 2. We've applied for the FMLA, or I'm sorry, not the FMLA. We've applied for the PPP loan, and we close on that at the end of that 2-week period, and then we're continuing to pay those employees now with PPP money. So that's kind of the strategy. I think that our opportunity to defer at maybe as long as some businesses would have liked, end of April, end of May, middle of June. I think that that's largely going to be cut off at this point without delaying applications, and delays of applications risk risk the money running out. Jeremy, what have I missed there?
No, I think that's stated correctly. Yeah, our hope was in a perfect world you could time the receipt of the proceeds at the same time that you were looking to ramp business up. So either your employees would receive, if they were furloughed or laid off, receive the benefits of the expanded unemployment. To the extent you kept people on and were utilizing those tax credits that we just discussed, the FMLA and emergency sick leave to provide leave, you could do that and then ramp up employment in time to begin to receive the loans and then begin paying wages, and salaries out of those loans that would be subject to forgiveness. Yeah, 10 days after close appears to be where they've landed, they being the SBA has landed associated with that. So that takes away some of our planning associated with that. Having said that, though, I mean, look, everyone's goals and incentive is obviously to maximize the amount of the forgivable portion of those loans. And again, whether that comes down to a situation of just paying people to sort of be quote unquote on call, even if there's no work available to them, I mean, that is an option. At the end of the day, too, if businesses end up utilizing these funds and not able to, expend all of them during the 8-week period, on salaries, on wages, in addition to those other qualified expenses, worst case, you've received a low interest rate loan, and you're in no worse situation than what you were before. You could go ahead and pay that back. And you've been able to take care of those people you have been able to employ based upon these government funds. So again, it's helped you keep some people, working, help you maybe keep the doors open, maybe 100% of it's not forgivable, but you're still in no worse situation than what you were before. But yeah, it would have been nice if we had a little bit more flexibility as to when we can time that, to try to get to the most optimal situation. But that doesn't in any way diminish the benefit of this program. Looking at this next question, I don't know if you had a chance to look at that, Mark, while I was talking.
It just popped up.
Okay.
While we're reading that, I might mention one other comment on the line of discussion we had earlier on FMLA Plus, as we called it, and the emergency paid leave, the 80 hours of paid leave. If your business is totally shut down, or you have locations that are shut down, those requirements evaporate. So that's a question that we've gotten a lot of. And the other question we had, there was confusion about the dates and the way the kind of COVID crisis swept the country. We had people in March who were potentially receiving paid leave. And so the question was, the effective date was April 1st for those two provisions. So do we get extra credit or relief for what we paid in March? And the unfortunate answer is no, we're looking just at April. So that's why in our comments, we referred to the start of second quarter 2020 for that program.
Well, I don't know that I've got a good answer related to Blake's question here. So basically the comment is, if we want to offer retention bonuses directly, is there a way to avoid typical payroll taxes on those bonuses? Nothing is jumping out at me associated with how to avoid the employee piece, short of some payroll tax relief that hasn't, come down the pipeline yet. Mark, anything you're familiar with on ways to structure that would help them avoid payroll taxes on that?
No, I don't think we have anything statutorily that covers that. But remember, if your business benefits from counting that payroll in a PPP application, so a simple example, your payroll runs, $20,000 a month. So 2.5 times that is $50,000. So there's a $50,000 PPP loan application that's received. There's some discussion that these types of bonuses might be a way to help soak up all of that, especially for businesses that might not have enough rent, utilities, and payroll in the next 8 weeks to absorb 2.5 times payroll. So in my example, normal course of things, you'd have, if you had constant pay and constant headcount, you'd have 40,000 of payroll that would come over the next 8 weeks. So there'd be a 10 that you'd need to have in rent, utilities, etc. And so if that 10 gets spent by paying your people, then it could be that 10 helps you to have an amount forgiven that otherwise wouldn't be forgiven. But again, Jeremy and I had a conversation before we hopped onto this call about some of the things we don't know, and there's maybe a list that's significantly longer of all the things we don't know than the things that we do know. But the question is, when we're thinking about bonuses that are paid within this 8-week window, are those going to be annualized, or the fact that we infuse the cash during the magic window, does that ensure forgiveness? So, for example, if a business funded its the employer's share of retirement contributions, if that's normally done in January for 2020, January of 2021 for 2020 and accrued back, can we kind of partially fund that along the way and have the cash outflow hit it within the magic window? And I think the answer on that is I see no problem with counting at least 2/12 of that, but I don't know whether we're going to be able to count 100% of it.
Yeah, and I guess the other piece is, if the employees, the concern is it obviously reducing the amount of take home on the employee side. If you have excess PPP funds that you need to expend, and we get the ability to count towards forgiveness whatever is paid during that time, and it's not prorated in any way, you could do a little bit of a gross up, say, look, this is what we had intended to pay, we're going to gross it up slightly, to cover, to knowing there's going to be a payroll tax hit. Obviously that would be subject to payroll taxes, but try to gross it up a little bit if you have room in that. But it's going to, the success of that will be dictated by, to Mark's point, how we get to calculate wages paid in that period. When you get something like a bonus, for example, during that period, do we have to keep all of it because that's when the cash left, or do we have to prorate it? The interesting thing about the PPP is that conceptually it's very simple. 2.5 months of typical salary, we'll loan you the money and we'll forgive it if you spend it on payroll and these other expenses that you're going to incur, even if your business, operations have shut down. Really simple in theory, but as we start looking at the details of, okay, what gets included in the amount of forgiveness, as Mark just pointed out here, if we look at, how do I count, how do I measure whether or not, I have an equivalent number of full-time equivalent employees is what I had during the baseline, and you get multiple baseline periods to choose from, and you get the option to, but if I have fewer than what I had during the baseline, I get to rehire people and potentially not get, a reduction in loan forgiveness. Really simple conceptually, but there's still a lot of work to be done, even for those businesses that have accessed the funds, and have had loans approved, figuring out, okay, how much of it do we actually get forgiven, and how do we plan to maximize forgiveness over those 8 weeks? That's really the next step.
Quite right.
This is Matt McCormick with the Chamber. I appreciate all the information. I've gotten a couple questions off the chat also that I wanted to ask y'all real fast.
Excellent.
First and foremost, as you said from the beginning, there's multiple programs here that businesses can take advantage of, and some mix well with others, some don't play well with our other programs. The really important part with that, though, as you said, was making sure that you're getting with your CPA, financial advisor, your bank that you currently have a relationship with, and really look at all of these and say, okay, what's going to be best for my business, correct?
Yeah.
Go ahead,
sorry. Yeah, but say absolutely. Because, we've tried to take a look at this, and we've mentioned it a few times during this, is that, if you kind of look at all of these together, seemingly, generally speaking, the PPP probably gives you, in most circumstances, an optimal outcome or maybe the most flexibility. But even that is a generalized statement. And so I absolutely do. Yeah, I absolutely agree. I think Mark would agree. You're going to have to look at your specific situation. The webinar that I made reference to at the beginning, the framework for that was taking kind of 3 general situations and trying to determine what the cost benefit analysis of these were. And that's helpful. And but that's every situation, nothing is going to be a generalized situation. There's always going to be individual quirks related to your particular business, the makeup of your employees. So yes, you need to constantly be in contact as it relates to the planning side of this. Hopefully you have been, as you tried to calculate, whether it was accessing the PPP loans or utilizing one of these other tools, and then continuing to monitor the situation and figure out if you need to maybe pivot or, what work is left to be done in some of these situations, such as a PPP loan forgiveness that I mentioned. But yeah, absolutely agree on that.
Yeah, Matt, I was just going to brag on Jeremy for a second. He put out a really nice white paper on the stylized optimization that I think would be a good starting point for businesses, and is available for free on our website for anyone who wants to start with that when they're talking with their banker or other advisors.
Wonderful. Another question that we received is dealing mainly, it's really focused towards the PPP program, and it's dealing with LLCs. Can the amounts paid to members of the LLC, or in this, and y'all know how that works, but basically the owners of the LLC, but their amounts paid to the members, can that amount be included as part of the total payroll for the PPP?
Oh boy, that's a fun question. So the PPP program has this weird convergence of tax terminology and SBA terminology, and further confounding things is the fact that the SBA is trying to do this so quickly, and so sometimes they mean what they say and say what they mean, and sometimes they don't. And so you can read 2 paragraphs sitting right next to each other in an SBA guidance that has been put out to clarify things, and they're in direct conflict with one another, as though Jeremy wrote one and I wrote the other, and we didn't read what we wrote before we hit print. And so, Matt's question gets to what interaction does tax classification have on eligibility for PPP, 1, and 2 is Congress did a very poor job, and again, I don't say that to be political or anything else, that they're trying to move very quickly, but the language that they used for what costs are eligible as payroll costs to calculate the 2.5 times loan amount is intelligible, but barely, and it's hard to say whether they meant what they said or said what they meant. And so an example of that is that payroll costs as a general matter in the statute include amounts paid to or received by independent contractors and self-employed people. And so the interaction between the two, Matt, is that single owner LLCs are taxed as sole proprietorships. And so it creates this confusion of how do you even fill out the application? Do you mark sole proprietorship because that's your tax classification, or do you mark something else? LLC box they added last Thursday to the form to help with that clarification, help provide clarification there. So there is statutory support in our view, I think I will speak for Jeremy here, for including amounts paid to or received by self-employed individuals in an initial application of a single owner LLC. But that's not how the SBA has interpreted it, and the banks have the very difficult job of trying to set rules and policies that they're not going to regret 2 or 3 months from now today with imperfect information. And so a lot of those decisions are being made either at the bank level, and some banks are saying, look, we're not on the hook for anything on this application. It's the applicant's responsibility to make sure it's right. You work with your advisors to fill it out and make sure that what you're saying is right. So a lot of the banks have left on their spreadsheets that they've used to try to streamline loan processing. They've left on their amounts paid to independent contractors, and they've left on their amounts subject to self-employment in some cases. Although our advice to clients has been, once you put the owner's numbers on there, unless you're an S corp where the owner is actually receiving wages, once you put the owner's number on there, you're probably, from an administrative perspective, going to make it look like an application that should be processed this week, not last week. And so we've had a lot of people who have pulled those numbers off, filed the PPP application based on employees last week, and then are awaiting this week and guidance that as of 11:51, I don't think we have yet, of what exactly information we need to provide to help the proprietor, the owner of that LLC, to apply for his or her share of the income of the business. And just an illustration of the confusion in terminology that Congress used when it described what income of a self-employed person qualifies. They used the words wages, which we don't really understand what the wage of a self-employed person is. Commissions, which is a gross number, and then it used net income from self-employment, which is a net number. So we still don't know what period they're going to look at for documenting self-employed people's earnings. We don't know whether SBA is going to take a gross or a net view of what someone's earnings have been for purposes of calculating that amount. Jeremy, what have I missed on that question?
No, you have. I think that's right. I think in the situation where you have LLC members that are taking distributions of profits, I think that's a little. I think it's more clear in our minds that portion of it probably should be includable in the applications for self-employed individuals beginning tomorrow. The real interesting situation is if you have guaranteed payments to partners or guaranteed payments to LLC members that more closely, for services rendered that more closely look like wages. But I don't even know in that situation, given that the IRS, that they've taken the position, say, I guess Treasury and SBA have taken the position that payments to independent contractors should not be included. I think there's probably some question about whether or not even guaranteed payments to LLC members fall within the application process that will kick off tomorrow versus includable as wages in the applications that started last week.
And I might just add, I will promise you that on this call or in our community, there are businesses that have had it handled either of two alternative ways, if there are just two alternatives. And if it goes through the bank and it goes through the SBA, that doesn't give me a lot of heartburn. If we were out of money going into the self-employed individual round, maybe that gives me a little bit of heartburn, but I have very little faith generally in banking on Congress to fix problems. Not to mean that they aren't trying or don't. I just don't like people relying on that. But I do feel pretty good about the idea that the PPP program is going to have more than $349 billion allocated to it when the dust settles on this. So I don't feel like there's kind of a gold rush scenario there or Oklahoma Sooner scenario. where someone's going to get in trouble for having gotten to the money sooner than they should have. I think the important thing is that you don't double dip. You can't have your cake and eat it too. Treating the owner of the business as payroll last week and then filing again this week as a self-employed individual. One bite at the apple is all we get, and that was really what was underlying the Treasury and SBA's approach to the guidance that they've come out with in the last week or so. Is Congress gave us really confusing language about whether payments to independent contractors, for example, were going to qualify. And so if you took that to the extreme, that meant every construction company that pays its subs were going to count as payroll the payments to the subs, and then the subs were going to apply and claim it based on their actual payroll, and you were going to end up with this multiplicative effect that was going to exhaust the resources really fast. So I think that pragmatic reasons were really underlying a lot of the interpretations that have come out.
Thank you. I know it's a very cloudy and very muddy mess and process to go through, but appreciate you bringing some insight to it. And a big thank you also, as you said, to our bank and financial institutions that have been working through this, and also to y'all and all of our other CPAs and within our community that are helping all of our businesses try to navigate this. As you said, much of it's very confusing, and or they haven't gotten the regulations down and trying to figure it all out as we go, or build the plane as we're flying it.
Yeah.
So very big thank you to both of y'all for taking your time. I know you are extremely busy and speaking, but taking time to speak with our business community. Again, going back to what you said earlier, make sure that you're sitting down with your CPA, banker, payroll company, those relationships that you currently have, those organizations you currently have relationships with, and look at all the different programs and figure out what's going to be best for your organization. As you can see on our website, or on the meeting, there is a resource page up that shows all the links to different processes of this. So thank y'all very much. We're forever grateful for all the work that you put in. I'd also like to thank everyone who joined us today for taking time to do so. We understand how challenging and difficult these last few weeks have been to you both personally and professionally. Please know that everyone you heard from today, the Columbia Chamber of Commerce and our community partners are here to help you. Please follow us on Facebook, Instagram, Twitter, and LinkedIn for continued updates, as well as our COVID-19 resource page at columbiamochamber.com. Remember, this recording will be loaded up there, so if you need to go back to any of the information that was discussed, you're welcome to go back to it as well. Be watching for more webinars coming soon, and thank you, and stay healthy and safe, Columbia.